Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I'm one of your co-hosts, Ben Barzideh. I have my co-host, Matt Nadeau, here.
Hey, everybody.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here locally in Barrington, Illinois, and serving the greater Chicagoland area. And our fiduciary obligation to put our clients first is the tenet of our company philosophy, and it guides every decision that we make. And as an independent firm, we truly have the freedom to focus solely on you, not some big corporation.
Yeah, and as always, we just want to take a moment. We know a lot of our clients are out there listening to us today. Obviously, we appreciate the trust you place in us, and we love every one of you. And we have a great show today. Few topics we're going to talk about. There were some market movers this week. We had Oracle. What just happened with Oracle this week?
My goodness.
It's literally now like in one day, I think Larry Ellison made $1 billion or $100 billion.
He almost surpassed Musk for the richest guy.
I think he did for a minute.
Yeah.
So we're going to talk about Oracle. We're going to talk about jobs and the jobs numbers. Basically, with the question is, are we really looking at a labor market issue that could cause a recession? And then later in the show, we're going to talk about something we call the widow's penalty. So you don't want to miss that. You'll hear what it is and learn more about it.
And you were breaking up for a second there, Matt, but it's going to be the widow's penalty. And it's a very important thing to be aware of. Now, before we start, we also encourage you to follow our BN Wealth social media pages. We're on Facebook and Instagram. And for any interesting updates and timely news during the week. And lastly, please subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's extremely informative, succinct, and easy to read. And you can sign up for that on our website at bnwealth.com. All right, let's get into our first topic today, Matt.
I want to come back to Oracle. So it was crazy. Think Oracle on Wednesday, after its earnings report on Tuesday, it shot up 36% in a single day. I saw at one point it was up over 40%. And it was literally the biggest one-day jump since the dot-com boom of 19. And here's the thing, it wasn't that Oracle's earnings crushed it. It was they were gushing analysts about their growth trajectory and its prospects all around high. And so Oracle is seeing this cloud infrastructure, their revenue climbing by $144 billion over the next 4 years. And that's up from just $18 billion for this fiscal year. And that really is critical because it reinforces how this AI trade is truly in full steam ahead with no end in sight. And it also bodes well for the future outlook for many of the other tech behemoths like the Magnificent Seven companies when we're looking at this AI stuff happening with them.
No doubt. So the other big thing that happened this week, jobs revisions. And is the labor market indicating that we're actually in a recession? So revisions to the Bureau of Labor Statistics non-farm payroll estimate for the 12-month period ending in March of 2025. So it was a while ago, but it was released this week and it was ugly. And the revision was that there was a negative 911,000 jobs. So that's just massive. I heard that. I'm like, say what? And counterintuitively, right after the announcement, yields went up, not down. And the reason being the case for the Fed initiating an aggressive rate cutting cycle due to a sudden downturn in the labor market, well, that loses some merit if the jobs market was already weaker than we thought all along. So that begs the question, does anyone believe these jobs numbers anymore? I certainly don't. And why would we? First, a few weeks ago, if you remember, we had those recent revisions that caused Trump to fire the lady that was the labor statistics chief. Now we find out that actually the labor market has been abysmal for about the last year and a half. So at this point, honestly, the only job I know for sure, without a shadow of doubt, that was created is us officially adding my wife, Andrea, to our company payroll a few weeks ago. I can vouch for sure that was a job that was created. I don't know about the other ones.
And I don't think they even counted that. We need a recount. We want to add that one to the negative 900,000 that they adjusted it to. So what that really all starts looking like is that we could definitely be either in or near or might be in a jobs recession. And then the greater question, of course, is does that mean we're also currently in an economic recession as well? So, usually, as jobs go, so does the economy. And if so, we really have to think what does that mean for the markets? So, to inform our listening audience, there's a few key metrics and markers we're going to be looking at so that you can look at. So, obviously, one of the big ones is jobless claims. Want to make sure people are working. So, if you hear jobless claims break over a level of $260,000 or 260,000 jobless claims, if it breaks that level, that is going to signal there's real deterioration in the labor market. And then it gets worse where the warning level's really going off once we get above 300,000 jobless claims. If we get above that on a 4-week moving average, that looks like the job market is contracting. Now, of course, you want to look at the unemployment rate. If we start seeing a move above 4.5%, get to 4.6 or higher, that is consistent with deterioration in the labor market and, of course, consistent with economic slowdowns. And then the last one we're looking at is job openings. And we call this JOLTS, JOLTS. Anything below 6.5 million new job openings would indicate companies are pulling back significantly. So during economic slowdowns, this JOLTS report drops towards about 5 million. And JOLTS actually hasn't been below that 6.5 million threshold I was talking about in years. So if we get a decline below that, obviously it means companies are slowing down their hiring, they're hunkering down on expenses, and all of these factors would put a headwind on the economy and lead to a potential slowdown.
So, how would a bad labor market impact the markets? That's the next question. According to, in our opinion, considerably, if it actually causes a recession, likely a 15 to 30% drop in the S&P 500, easy, maybe even more depending on how bad it is. Usually recessionary type of bear markets they cause more damage than bear markets without one. And normally a decline in the jobs market is a lagging indicator because usually at that point, we're already in a recession as employers only slash jobs after the economy has already slowed. And by the time the Fed realizes it and starts actually cutting rates, it's too late at that point. And that's why historically, most of the drop in the market in a recessionary market crash happens once the Fed actually starts cutting rates. So bottom line, the current labor market, in our view, currently right now is not bad enough to warrant a massive defensive shift in positioning or anything, but it's clearly something we're concerned about and we're going to be monitoring going forward. And in our Advance and Protect tactical investment models that we manage for our clients, we have a plan of attack for either one of these scenarios. If the market continues to do well, we're going to keep riding this trend. And in fact, as some of our listening audience knows, we've been last few weeks indicating that in some of our more growth-oriented models, we're actually currently pedal to the metal, 100% in equities, as all three of our buy and sell indicators that do a diagnostic check of the health of the market, they're all positive at the same time.
And this is what makes our process unique and different. If the market starts getting more risky and starts to deteriorate, we will actually do something about it. We'll get more defensive by actually selling out of the stock market. We'll go heavier into whatever is more risk-free assets like bonds, maybe even cash. And we'll do that waiting for market conditions to improve, right? When you're in retirement, it's not the time to be riding market crashes all the way down to the bottom. So having a process or a plan to limit those potential losses is paramount to us. So you can always hope for the best, but you need to plan for the worst. And that's part of our fiduciary duty of looking out for our clients and doing what's in their best interest. So my question is, do you have a defensive plan to help protect your money from a potential market crash? So if you're hearing this and if our investment philosophy resonates with you and you're looking to have your money managed like that, reach out to us and learn more about our Advance and Protect process. You can find us at bnwealth.com or call our offices at 847-780-2980.
And in just a few weeks, we are actually having our first high-end Bordeaux wine tasting events, and not Bordeaux, but Bardo. It's our last name. So it's a fun event. We're going to have a quick presentation. If you want to learn more about us, come to that event. do a reservation for it. You can call us at 847-780-2980. All right, we're almost out of time. When we come back, we're going to talk about the widow's penalty. We'll be right back.
Welcome back. Thank you for tuning in. This is the Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What's better than that? And I'm one of your co-hosts, Matt Nadeau. I have with me my other co-host, Ben Barzideh. And right before we went to break, we got cut a little short, but I really want to talk about how we have, in just a few weeks, for our listening audience, a high-end Bordeaux wine tasting event. You heard me right, not Bordeaux. Barzideh Nadeau Bordeaux. I guess it's a cheesy joke. It's our last names.
It's a good pun.
There we go. But it's going to be a fun event, and it's solely for those that have been listening to us and considering potentially working with us. It's going to be a low-pressure, fun environment. We're going to have a 15, 20-minute long presentation, just basically about what makes us unique, a little bit about our investment process and how we work with our clients. And then guess what? We're going to have a little food, some of our favorite bottles from the Prisoner Wine family. You know, it's October 23rd from 6 to 7:30 p.m. right here in our office in Barrington. So since it's October, we're going to do a little prisoner tasting, get close to Halloween, but it should be a great time. You can meet us, learn about our firm, and to register for this event, call us at 847-780-2980. So anyway, let's get back. One of the things that's also important to us, and we'll tell you a little bit more about this at our event and over time, is our company motto: do great work, have fun, and give back. And we believe that with prosperity comes charity and value supporting churches or charitable organizations that are helping our local community.
Therefore, we are so excited to announce that in the upcoming weeks, we will be launching the philanthropic arm of our company. We call it BN Giving. And we don't just talk about purpose. We actually want to invest in your purpose with you. So if you become one of our clients, and you're a faithful tither or a regular giver to a charity, as long as it's an official 501c3 organization, just let us know and we will match your donation up to 10% of the management fee that you pay us each year. And by working together, hopefully we can magnify our impact. And this is a whole movement we're trying to pioneer here that is unique to our firm, based around the culture of giving and a more altruistic way of doing business. And if we can grow our client base with like-minded people, those who share our vision and values, well, that would be incredibly rewarding to us. And by the way, if you're not a regular giver, that's okay too. We'll still be happy to work with you. So to explore how you can join our tribe and become a client, reach out to us online at bnwealth.com, or of course, you can call our office at 847-780-2980. All right, Matt, let's talk about the widow's penalty.
It's all this fun, exciting stuff, and now we're going to talk about widows and widow's penalty, but it's definitely something that comes up as we work with our different client families, and it's actually a consequence that happens when a person's spouse passes. And what we'll see is that, of course, their income tax filing status changes from married filing jointly to a single filer. And this change can result in the surviving spouse having to pay substantially higher taxes on a lower level of income than when they were filing as a married couple while both spouses were alive. So we're going to use an example, try to drill this in a little bit so you can see the penalty here. And we're just going to use a hypothetical married couple, Bill and Jane. And we're going to try to keep it simple. So we know we're on the radio. We don't want to get too deep in the weeds. But basically, let's just say they're both on Social Security and they're both over the age of 73. That means they have to take those required distributions. And as such, their combined annual income is, let's just say, $72,000 for Social Security. It's $48,000 for Bill. Let's say half of his for Jane, $24,000. So add them up, it's $72,000. And then we'll just tack on another $70,000 for their required distribution that they're taking. So combined $142,000 of AGI, adjusted gross income. And after we take all these standard deductions, their income tax, let's just say, was around $11,000 of tax they're going to have to pay. And it does sound bad. You got to pay the government $11,000. But Ben, it actually gets worse when Bill passes away.
Bill's death results in two major changes to Jane's tax status. First, after the year of death, Jane can no longer file taxes as married filing jointly. she now has to file as a single filer. And then the second thing that happens is Jane switches to Bill's Social Security. And as such, she loses hers. So her Social Security is now 48,000 because she stepped up to Bill's higher amount. But because she lost hers, they don't have the combined 72,000 that they had when Bill was still alive. So that means less household income. And she also rolls Bill's IRA over into her own IRA as a spousal rollover and continues to take out $70,000 a year, as she also needs to take required minimum distributions and is certainly dependent on that income as well. Now, because her filing tax status is now single, it actually takes less income to get into the higher income tax brackets versus when Bill was still alive and they were filing jointly. So even as Jane's overall income declined from 142,000 a year to 118,000 a year due to the reduction in Social Security, her income taxes actually rose from $11,000 a year to around $16,000 a year. And her effective tax rate basically doubles from 7.7% to now around 13.56%. And she'll have $29,000 per year less to spend. That actually an extra 2,400 less a month that she has to spend every single year.
I mean, this is terrible. Like, not only does Jane lose her husband, Bill, she gets hit with this tax double whammy where first the standard deduction, it's a giant standard deduction right now, but it gets cut in half. And then second, those brackets as a single filer are now much smaller. So for example, the $96,000 of taxable income they had when filing jointly would only put them in the 12% tax bracket. But that same amount, you are solidly in the 22% tax bracket as a single filer. So this end result of all of this mess is that not only as a surviving spouse do you potentially have all this, less income, but you also get hit by a larger tax bill.
So can anything be done about this? And yes, there are ways to plan for this and try to minimize the potential of future taxes, but it often takes time. And one way is by converting a pre-tax IRA over to a Roth IRA while both spouses are still alive through something called strategic partial Roth conversions done over the course of many years. Especially in years where maybe there's a reduction of income, which would allow for even a higher conversion amount that year. And definitely in the year the spouse passed, as that is the last year in which a surviving spouse can still file a joint tax return and take advantage of the higher income thresholds. And if done correctly, someone may be able to convert all or at least a big part of their IRA over to a Roth, and that can help reduce the potential negative aspects or impacts of the widow's penalty.
Yeah, and Ben, that's one of the hard conversations that I always have with these surviving spouses is in the year when the spouse passes away, we're here to help them through the whole process. We help them with any kind of inheritance issues, estate planning. We walk them through any inherited IRAs for some people. We help them with transitioning IRAs for a spousal rollover. And one of the things as a fiduciary we need to help them with is understand that I know you're grieving and we're dealing with some of these issues, but this is the last year that you may be able to have some impact of doing either like Roth conversions or income strategies while you're still able to be married filing jointly. And that's where you need to work with a professional like us who really can help identify these opportunities and hold your hand through it all.
Absolutely.
Anyway, yep. Well, we're getting close to wrapping up for this week. Hopefully everybody's going to have a great weekend out there. But again, like when we started out this segment, want to let you know we're having this wonderful high-end Bordeaux wine tasting event. Again, not Bordeaux, but Bardot, our last names. And again, this is a fun event solely for new people who want to be introduced to our firm and potentially work with us. I know a bunch of you listen to us now, listen to us back before. This is a great way with low pressure, fun environment where you can come meet Ben and I and our staff. You can drink some amazing wine. We're going to do a 15, 20-minute long presentation where we talk about what makes our firm unique and how we can help you. But then we'll jump into having some food, some of our favorite bottles from the Prisoner Wine family. And it's Thursday, October 3rd from 6 to 7:30 p.m. right here in our office in Barrington, and it should be a great event. So to register, please call our office at 847-780-2980 or go to bnwealth.com. You can find out more about us there. And of course, if you've listened to us for this long and you want to explore becoming a client, we'd love to schedule a complimentary consultation where we can look at your personal situation, take a look at your full financial picture, go into more detail about our unique advance and protect process. And we would love to just see if we can help you. If not, that's great. I mean, if we can, that's great. If not, we'll part friends. You can keep listening to us for updates, but we'd love to have the opportunity to see if we can help you. So again, you can reach us online at bnwealth.com or call our office at 847-780-2980. All right, we're running out of time. We hope you all have a great weekend. God bless, and we'll see you next week.